Hello, everyone, and welcome back. Our next guest is, I've seen him speak before, and I've always enjoyed it, Paul Whelpton, the CIO at JUMO, who is going to speak to us about building a more inclusive economy, how AI credit modeling can reduce bias and make better decisions. Paul, super duper important conversation around bias. We've heard about the bias in facial recognition, and I'm sure it could be rife in financial decision making. So we really look forward to listening to you. Over to you.
Thank you, Anne, and good afternoon, good evening, good morning to everyone, wherever you're joining in the world. Thanks for attending. Really excited to share a little bit of the JUMO journey with you and some of the thinking that we've got on the topic. Just as a quick speaking note, so just going to do a quick introduction to myself and what we do at the team, and then we'll jump straight into the questions. Seeing as this is a virtual conference, I always find it quite intimidating not to see the people. So if you would entertain me, please use the chat box for this one. Just before we get started, I've got a slide up here that says 2 truths and a lie. So maybe just so I can see who is actually listening on this one and just interact with you guys. So I've got 3 statements there. So the one says, I'm a heavy metal guitarist. The second one says, I'm so scared of spiders that I once destroyed a door with a tennis racket trying to kill it. And the third one says, my biggest achievements was that I ran the Boston Marathon in 2017. So maybe if you guys just in the chat box, 2 of them are true and 1 is a lie. So maybe just go A, B, C, which one you guys think is a lie? Just as a bit of a start. Got quite a few A's, spiders for sure coming through. Got someone saying B is true. Thanks, guys. Thanks, Lisa. Thanks, Reno. Awesome. Thanks, everyone. It's good to see the names. It just helps me a little bit to see who I'm talking to. I see there's someone. Thanks. Santam. Ooh, I hope you guys weren't on the call yesterday when I was quite harsh against the insurance companies. Yeah, so actually the one that's a lie is the Boston Marathon. That's not true. I am indeed a heavy metal guitarist. Maybe that tattoo on the picture gives it away. I'm very, very scared of spiders, and that actually happened. I destroyed a door. But yeah, I did not run the Boston Marathon. I've never gone further than 5Ks in my life. Okay, so just a quick intro to JUMO, just so for the people that don't really know what we do. We're a financial technology company, and we really focus on lending and savings products in the mass market. So we've got a financial inclusion angle to everything we do. And we're trying to bridge a massive gap of underserved or customers that are just not included in the financial system. We were founded in 2015, and this is just some of the numbers of where we've got to. And I'm going to share with you a little bit on some of the ways that we look at specifically on credit and serving these markets. So we've served about 18 million people to date. We've disbursed 105 million loans on our platform, $3 billion cumulatively in disbursements. So quite a big number there. I think the number that we are very proud of, and it's really what the gist of what I'm going to talk about today is about. Like, we've got just below 4% cost of risk or NPL ratio on the platform for this kind of mass market, thin file customers, you want to call it. Like, we're very proud of that. We're active in about 7 markets. A third of our customers are women, and that's something I'm going to touch on a little bit as well, just from a bias perspective. And then a very low cost to serve. So a cloud-based company focusing on making sure we do this as efficiently as possible. Just talking a little bit about financial inclusion, specifically the massive market that is underserved at the moment. Like, one thing that we truly believe is that this is a supply issue, not a demand issue. So if you look at these markets, I'm sure most of you would have seen any sort of kind of presentation talking about the bottom of the pyramid or how big this opportunity of the financially excluded are. And we truly believe that there is a massive demand for credit in these markets, but that it's been very difficult to solve because we've not been able to get credit, or the traditional financial players have not been able to get credit into the hands of the people. And it really is important that we solve this, like, not only from a financial perspective, and that there's obviously huge profit pools to be made and it's a new asset class, but also, like, for people's livelihood, it's something that we believe in very strongly, is that you should have access to financial choices. So thinking a little bit about why that exists and why there are so many barriers to get there. Obviously, there are the the very simple ones, unit economics and things you need to solve, but also from a pure credit modeling perspective. I think there's a few things that we've been tackling over the last 5 years, which I think is which is important to highlight. So I'm going to use a story of one of a customer. We've changed the names here just to keep things anonymous, but so let's meet Pratika. She's a small-town farmer in Pakistan, and this is, to me, is the perfect example of trying to understand some of the biases that we can see in credit modeling. So the scenario we're talking about here is there's a drought predicted in Pakistan, which means there's going to be significantly lower yield on her crop. And the important thing here is, like, what does traditional or any sort of credit modeling think about this? So I think there's a lot of people on here that would work with models like this, so trying to predict a default event. I think it is fair to say that probability of default for Pratika is definitely going up. It's a very strong feature in any sort of model that if a drought is going to hit, if you're an agricultural farmer, it's not going to be the easiest year. So this is the scenario that we're going to work with just to illustrate some of the biases that we see in credit modeling. So the question that I'm posing to today is, like, is credit scoring or credit modeling inherently biased? And to illustrate that, let's use this example. So traditional credit thinking on Pratika, we're saying definitely the probability of default goes up. So what are we going to do? Let's price for risks. I think most organizations in the world would agree that risk-based pricing is something that is now tried and tested, so we have to price for risk. So her price is going to go up from 10% to 17% because we know she's going to be high risk. We also want to minimize our exposure as far as possible. So for the bankers on the call, LGD is important, so the loss given default. So we don't want there to be too much exposure. So we're going to limit her access from about $2,000 to $1,000 because we don't want to take too much risk or exposure in the segment. And in a lot of financial institutions, there's also an annual fee to keep your credit line open. And that's usually also risk-based. So we're going to move that from 1.5% to 3%. Then let's think about what that outcome means for this scenario. So firstly, the weather prediction was right. It didn't rain. The crop yields less. Interest expenses are now very high. So obviously we've increased the price here. And she's got reduced income. So her yield on her crop was a lot less than previously. So she doesn't have the disposable income that she used to have. So now Pratika defaults. She can't pay this expensive loan because she still needs to live, right? She needs to get her family through another year. And the main source of her income, which is a farming business, did not get the same results she was expecting. She also can't plant for the next season because her exposure was dropped from $2,000 to $1,000. So she can't really work for the next 12 months to catch up what she lost year. And there's potential that she could lose her farm. So from a credit perspective, our credit model worked perfectly. If I was the head of credit and I made this decision, I'm pretty happy because my prediction got it right this time. And the feature which says weather dependency on probability of default seems to be a very strong feature. This data is also going to go back into my data set. So when we're talking machine learning or AI, this will go down as I predicted a bad, it was a bad, so big tick for my model. And next year, when I train my agricultural scoring model again, it's going to be even stronger feature because I've kind of proven that this works. So from a false positive rate, this is a no-brainer. I'm proposing, like, is there perhaps a different approach to this credit thinking that could change this? So alternative approach is still, I see probability of default goes up because this is a strong feature. But what if we change the product construct and give her something else? So we say, okay, instead of increasing the price and doing risk-based pricing, let's reduce the price from 10% to 5%. She also probably needs a little bit more runway because we know it's going to be a tough year. Her cash flow is going to be considerably down because she can't sell from a gross profit perspective as much as she could. So let's increase her credit limit from 2,000 to 2,500 and let's just waive the fees for it. And outcome still the same, doesn't rain, crop yields is lower, but now with more accessible finance and a lower finance cost than she had previously, she can get through the season. She's got a bit more extra cash and she can pay off not only this loan, but start planting for the next year and catch up. Also, definitely buying some loyalty because obviously getting through some of the toughest periods is something that's good for her. I think the interesting thing for me here is, like, what does this do to credit scoring? So once again, putting myself as the head of credit, for this alternative. Now my model looks completely different. So was my model wrong? So did I actually get this prediction completely wrong? And what do I do next year when I add this into my ML or my AI model to say, how do I predict this? Like, is weather maybe not a good predictor? Does that feature's importance go down? And how important was it, the way that I treated the product construct compared to actually the original the original prediction that we did on this? I think this is really something, a very simple example on agricultural lending to say, is everything we do from a credit scoring perspective actually inherently biased, and we are forcing a specific outcome on customer? Another good example of this would be in the segmentation of customers. So if we think about some of the more developed world banking products, we've got usually private banking, you've got your middle kind of class banking or middle market, and you've got lower income or inclusive banking. And more often than not, just based on that segmentation, not only do you get a different color card, but your more wealthy private banking customer interest rates would be a lot better. So there is a bias in there saying that because you have more money, you should be lower risk. And in South Africa, as an example, you could get prime -2 on any kind of lending you do as a private banking customer, where mostly in the inclusive markets, interest rates would be at the absolute max, and they actually have to be regulated by the central authorities because of how high those interest rates are. And to put that into perspective, prime -2 would be about 6-7% on a loan. The max interest rate in South Africa at the moment, I think, is 23%. So that's a very big difference. Now, are we actually just creating a self-fulfilling prophecy where you say someone does not have the means to really kind of, from a disposable income perspective, they're obviously not a private banking customer. That customer that's already under pressure, that needs financial services, now pay 23% on a loan, where someone with the financial buffer did not do that, pays only 7%. That goes back into a model, and obviously a lot less people default as a private banker, a lot more people on the lower end default, and now that risk separation is there again. If you look at it from a credit perspective, stick to your credit model. Income is a massive driver or feature of credit risk. Hence, this is why we should submit it this way. But same approach that I've got you on the agriculture. Like, if we turn that around and everyone actually got a fair offer, or maybe even turn it on its head and say a low income person should get a better interest rate and at a lower price than a private banking customer, would you turn the credit model upside down? And it's something that we're not going to solve in one day, but it's something that we've been really focusing on very hard and at JUMO, is to try and understand specifically what is the impact of price and the offer and the way that you use your prediction capabilities and how that would influence future machine learning. So I could build a credit scoring AI system that purely just keeps learning on the traditional credit thinking. I would probably get to near perfect prediction over time. But am I actually creating a bias by the product I'm giving and creating a self-fulfilling prophecy where at a certain point in time, a customer can never recover based on an initial bias? And once a customer is bad, it's almost impossible for them to become good again. You can imagine if Pratika in this example defaulted on a loan, she gets reported to a credit bureau, she's now blacklisted, and for the rest of her life, she will receive very bad credit products, if any at all. And every time she receives a bad credit product, which is overpriced and it's not the right exposure, her probability of defaulting that is even higher. Where if she maybe started this journey in a completely different product offer, we would have seen a different outcome. So where else can we eliminate biases? I think it's something to maybe think about. And when we get to questions and answers, I'm very keen to hear if there's any other views that the audience maybe has on where we could also see potential pitfalls, specifically in the lending. I think the first one is we spoke about now a little bit, which is pricing and product construct. I think reducing the self-fulfilling prophecy is a very important piece of what we've been trying to do and how we use our artificial intelligence and machine learning. There's a way you can exploit and explore at the same time using reinforcement learning. We had a good chat yesterday at one of the tables with a few of the delegates. One of the gentlemen there, Jay, actually brought this up as well, where you can actually play with the product construct that a customer sees and make sure we give the right value propositions to customers. So that's one thing that I think is a massive way where banks and financial institutions can change the way they see risk. The second one is transactional bias. So is thin file really a measure of risk? And can you segment before scoring? So that's one of the features that is most predominant in all credit scoring models that we've seen. One of the best ways that we've managed to reduce risk and get to the cost of risk levels that we are today is by actually taking that out of our modeling and making that a segmentation variable. Is to say, maybe you should see a customer with no transactional information, not as high risk, but give them their own scorecard. So use your most predicting and strongest risk features as segmentation variables and don't include them into your modeling. So that's one thing that's very strong and a way I think we can definitely include more people, because your bias towards high transaction or transacting customers would always mean that anything you've got on a thin file basis will be excluded. Gender bias, I think, is still massive. There's been a lot of chats in this conference about gender bias. I think from a credit scoring perspective, most regulation actually prohibits you using gender in any kind of scorecard. Our approach is slightly different. Like, if you don't explicitly try to focus on gender, you will never get gender bias right. So in Africa, one of the things we've seen is that the way women actually use their smartphones or their phones to transact is completely different. Like, as the head of the household, in a very much more traditional sense, it's usually the men that do the financial transactions. And if you build a scorecard purely based on transactions without bringing in gender, you'll probably indirectly have a very big skew to exclude women. So I guess the hypothesis here is to say, is it actually ethical, or is it not more unethical to exclude gender in the way that you segment? And should you not be building scorecards specifically for the way that women use this product in a specific context? So there's obviously a big difference in certain countries. If I just look at the countries we're in, big difference between Kenya and Pakistan on the way how women actually treat financial products. And if you just build a scorecard on a gender neutral basis, which is what most regulators force you to do, you'll actually exclude quite a large portion. And as you saw in our stats, we've got 1/3 of all our customers being women. And this is one of the ways that we actually eliminate that. The fourth one, target variable bias. Like, are we optimizing for multiple outcomes? Or once again, are we looking at one specific customer only? So someone that pays very early all the time, if that becomes your good customer, what about a customer that's going to be slightly late? And are you actually, should you increase your target variables to include more customers? And then behavioral bias. So not all customers are the same. So we have a big focus on personalization. And I think it's way before AI and machine learning became a buzzword, most people working with data focused on this kind of dream maker, the nirvana of segment of one. But I think it's something that still holds true. Like, segmenting customers into colors or tiers or any sort of kind of income-based model is very dangerous. And we've seen that the closer you get to personalization, actually seeing individual behavior for what it is, it definitely gives you a better outcome. From a business perspective, you can imagine a high margin trading business compared to a fast-paced kind of consumer turnover where there's low margins, different product, different risk profile that exists for those customers. So I know I'm going to run out of time quite quickly. We only have 20 minutes. So I really want to get to some questions and answers, but want to leave everyone with that thought, is to say, is there a way that we can focus AI and machine learning away from just getting our predictive models as strong as possible and actually eliminating some of these biases? I've got 5 biases that I've listed here, to include more of this kind of unserved. I think it's almost 1 billion people in the world now that are either underserved or not served. And is this maybe the first step to including more of them?
Paul, we have to almost end it off. I don't see any questions in the chat at the moment, but I would like to ask you a question, and it might be stupid or irrelevant, or maybe not. You mentioned gender bias, which is a very, very relevant topic. But what about gender identity bias? Is that something that's relevant or not at all in the context of what you're talking about?
So you want to just maybe explain a little bit what you mean with that?
I think sometimes I think I'm a bit old school. So my son recently asked me about some of these gender names, that people identify with. So people might say I'm no gender. I see a lot on LinkedIn these days that people will mention their names and call them him, her, etc. Now, there might be no relevance. Maybe there is. So I thought I'd just ask you about that.
Yeah, I think that's an interesting question. I think definitely. I think it's something that's in where we're heading in the world now. It's something that's very important to take into consideration. I think what we've seen mostly with these type of models that we use is it's not really about how many kind of genders you want to put in there or what the different categories are. It is if there is a different social norm or a different way that these people are interacting, that you can at least identify that. So whether you have 5 genders on there or no genders at all, I think what's more important than that is not including the gender in part of your kind of credit modeling. It's more about saying, is there a marginalized group, whether that's based on gender, race, occupation, or whatever kind of business model someone is running? And can you use a variable to identify that marginalized group to separate the way that you score them to compare to the rest of the base? So I think it's an excellent question. We haven't seen in our markets a marginalization of the use of these products based on any of that, but we have definitely seen in a few of our markets where just the social norms for women in some of these more traditional countries, the way they transactionally interact is quite different. And if we don't give special attention to say, can we actually enhance the value proposition to a marginalized group, whatever that group would be, you would definitely lose some power. I think agriculture, I know I used that example already, but that's another marginalized group that we've seen quite a bit in Africa. Like if you don't focus on that as a specific segment by itself, like you very rarely kind of miss some of the seasonality trends there, because obviously a farmer is not going to have daily income like a normal trading business.
We've there's one question from Satish that you've actually now answered, but he references Timnit Gebru who's an ex-Googler and who also appears in Coded Bias. So I've been following her work for some time. There's so much more to speak about on this very relevant topic. Paul, thank you for a very excellent presentation and real-world examples. It was a delight to listen to you. Everyone, hopefully we can speak to Paul a bit at the end of the event in some of the tables. We are running over a little bit, but I think it was definitely worth it. We're going to break for 1 minute and then we're coming back for the next speaker.